they are defensive. I think the market is up on this exuberance that the Fed might pivot quicker than expected and start to not only pause, but lower rates sometime this summer. I think what the market is really discounting is if the Fed were to pivot and make that move, why they would be doing that. Inflation numbers are still too high. The labor market is still very strong. We have a ways to go to slow this economy down. And so if they were to pivot so quickly, I think that would be because there was a crisis in the financial markets.
So you guys are still banging the drum on the inflation story, even though the inflation expectations have really come down and there's increasing evidence that it's slowing.
It's coming down, and the jobs number this morning came down, but it's still double, what it has been on average the last decade. And inflation, remember, the Fed target is still 2%. We've got a long way to go to get there. So it's just, perhaps this is a case of slow and steady wins the race. We just need to be patient. And as we all know, the market is not the most patient vehicle.
So does defensive mean cash? I mean, does it mean highs are in for the year?
Defensive means underweight equity allocations. It means taking advantage of the interest rates that we're seeing in the fixed income market, which are close to long-term equity returns with much less risk. And we do think, and I think your show this morning talked about, we expect a downturn in the market, and we want to be opportunistic about entering risk assets like equities, going back to our target allocation or even overweight at opportunistic times. And we think the market's going to present that a lot this year with the volatility.
When what happens?
When the Fed doesn't turn and pivot and the market recognizes that rates are going to stay higher for longer. Also with the banking crisis, we think that that's the equivalent of an additional rate hike of 25 or 50 bips. So I think once all of this settles in and the exuberance of the expected Fed pivot, which we don't anticipate, I think the market will come down and it'll be a great entry point. We want to get back into risk assets, but at the right time.
Do you think, we've talked a lot about sort of corporate cost discipline and headcount reduction and the year of efficiency. Does that mean that there's upside risk to earnings for, if not this year, then next?
There's a lot of pressure on earnings. And for us as financial advisors, what that means is using money managers who are going to do fundamental analysis on each company that they're investing in. The last decade was a decade of free money, increasing valuations, not a lot of care or concern for fundamental analysis. This market requires real due diligence, and that does favor active management so that the stocks that you're buying, the management teams can afford the leverage, have withstood operating through periods like this with pressure and higher lending costs.
So let's talk about what you like, fixed income alternatives, and what you're telling your clients to do. Munis still? Are they getting expensive?
We still like munis. High yield we do still like, but up on the credit spectrum within high yield, because with higher rates, there's a higher rate of default. But we are overweight fixed income. We are overweight alternatives. Again, analysis onto which private equity funds and managers you're going to go into. The discrepancy between top decile private equity funds and bottom decile is much greater than even in the equity space. So you really have to have a lot of care and concern for where you're investing your money, not only how.
Holly, we just wrapped up Women's Heritage Month in March and didn't get to talk to you. Had a lot of live hearings.
Somebody took the wind out of our sails on our women's show.
But I did want to ask you, because you are consistently one of the top-ranked female financial advisors in the country, and I know you've made it a mission to court female customers and clients. The economics here are completely changing. What have you found?
They are. It's interesting. We're on the verge of the greatest wealth transfer in our history. And women today control over 50% of investable assets. And that's going to go up to between 65 and 70% of investable assets this decade. And the financial markets generally have favored males. They're more relevant, more prominent. But we're seeing that with women controlling more wealth, the emphasis is not only on educating women, giving them confidence, but also selling to women and attracting women, which is different than speaking to men. And I speak to interns, I speak to housewives, I speak to stay-at-home moms, and encourage them to have confidence in their questions. No question is too dumb. and to stick to their belief, know what's important to them, and be able to convey it to anyone they work with.
And when you say the greatest wealth transfer, you're talking about from boomers to the younger generation.
Exactly. And we're going to see many more women, not only from a high net worth client perspective, but also women are staying in the workforce longer. We're seeing, women-backed companies. They're a very small percentage of companies today, but that number will continue to grow.
There's obviously a lot of research done that they trade with less frequency, right? Does that mean less volatility? What?
They trade with less frequency. That means it's more tax advantage. It means they tend to stick to their knitting. They have less of a knee-jerk reaction. And the statistics show that women have often better returns.
Right.
I mean, I don't want to say that to you here. You're
No,
a little outnumbered.
I'm well aware. It's not a mystery. What does it mean for spending patterns? And again, back to your conversation about the Fed and yields, is that an assumption that spending holds in? I mean, Diamond's letter this morning sort of looks at a balance sheet at the household level that's still pretty good.
It is pretty good. And so we're just going to, everything changes every day. And so today we're in line with being cautiously optimistic and having a lot of opportunities this year to put more money to work.
Holly, it's great to see you and catch up. Thank you very much for the time.
Thank you.
As always, Holly Newman.